Good morning, viewers. I am Binette Gasson, CRO at Catalyst Fund Managers, and this morning I am joined by Lance Besaidenout, Global Investment Analyst and Portfolio Manager of our Global Listed Real Estate Concentrated Portfolios. Lance, we've got a full agenda for the day. Viewers, today we will be touching on quite a lot within the global listed property space. We'll be sharing some from a macroeconomic point of view. We'll be touching on political factors at play, talking about various subsectors and headwinds and tailwinds that we've been seeing there, as well as then lastly some investment opportunities within the sector. So Lance, let's get right into it, and let's start with the macroeconomic factors and specifically talking the political factors at play. Last year was a strong year for elections, but let's focus on the US with Trump now being the US president, and let's focus on his policies. There are some strong policies that will obviously have various effects on various sectors, but for us, we just want to know what the impact is going to be on real estate. Maybe if you can just unpack that for us in quite a bit of detail, that would be great.
Of course, but it's a very topical discussion at present, given what all the things to consider. So Trump's pro-growth policies really are focusing on deregulation and on domestic economic activity and boosting it, whilst some of his other policies on the measures on trade tariffs play a bit of hardball with the rest of the world and really try and tilt the trade balance back in favor of the US. So on the one hand, that's great for the economy because it can boost it near term, and you can see the market reactions anticipating that as well. And on the other hand, it reignites fears around inflation risk and interest rates increasing or remaining in a restrictive territory to deal with that. So it's a bit of a double-edged sword in terms of how this can unfold. And the duality really is that on the one hand, a stronger US economy, stronger economic growth, that should be good for the tenants underlying the properties across various real estate sectors. And what's good for them should, by extension, be good for the landlord, right? On the other hand, if it does create this high inflation environment and interest rates have to remain in a restrictive territory, that can be a hindrance for real estate values and for debt serviceability costs. Fortunately, lessons learned from the past, I think management teams have done quite a stellar job on average fortifying the balance sheet. So balance sheets are really well capitalized. Loan to values or gearing levels are 30% or slightly above. Approximately 80% of debt is fixed rate in nature as opposed to floating. Debt profiles are quite well staggered, and the weighted average debt term is around that 67-year term, so also quite well extended. So when factoring in, the risk to interest rates going up and this interest rate risk, I think the sector as a whole is quite well insulated, both on the interest rate risk level as well as on refinancing risk level.
Lance, let's focus on the last quarter of last year, and we look at the regional divergence, and we look at the top performer and the bottom performer. Top performer is the US with roughly -6%. And then on the other side of the coin, we've got Canada with roughly -25%. So maybe can you unpack that divergence for us? What were the drivers in that divergence?
Yes, definitely. So, it's quite an extreme divergence, and I think those two countries you've picked are at the extremes within that whole real estate ambit. And I think the first reason is very much what I answered in the first question, is really those pro-growth policies that making the market take a more favorable outlook near term for the US. And I think it's quite easy to do that when you look at what's happening in the rest of the world. And it's not isolated to Canada, really. It's a rest of world issue versus US. So it's created this dichotomy. If you look at Europe and UK, the economies really are not in a good standing. So that's the first reason. The second reason, I think, is just that breadth of or the opportunity set within the US. So the composition of the real estate sector is, made up of traditional assets like the other markets in the world, but also sectors that are non-traditional in nature. So niche sectors where there are specialists that are really good at what they do, and they have created moats or competitive advantages. And even absent having done that, these sectors are just generally benefiting from structural demand drivers and and really they're in this period where they're getting more adopted, and hence the fundamentals are better relative to traditional sectors. Not at all points in the cycle, but currently that's what's being observed. And those sectors aren't really that available in other markets around the world, particularly in a listed format. So that's a second reason. And I think maybe circling back on Canada, because that was the question, is that they've really been grappling with some political risk, both on a provincial and on a national level. And that's highlighted now by the resignation of Prime Minister Justin Trudeau, right? So the market's clearly ascribed a risk premium to this political risk and leading to underperformance. And that's really compounded as well by fundamentals and the general economy just not being in the same standing as the US.
Let's go into, we've touched on, regional exposure a little bit with the US and Canada. Let's now focus on subsectors within the portfolio construction. So let's start with a stellar one, data centers being our standout subsector. What's driving that strong performance? And then also, what's your outlook for the subsector of data centers for 2025?
So data centers, like you say, it's a sector that's really gone from strength to strength. And the driving force behind it is this investment in artificial intelligence and cloud computing. And that's created this demand for digital infrastructure and is benefiting, as a consequence, data centers. Now, for everyone who's been in real estate long enough, there's two sides to the equation. There's demand and there's supply. So a lot of the time what we hear is, well, supply is at these crazy levels. And for the traditional real estate investor, they would look at your traditional sectors and be comfortable with that low single-digit supply level, sometimes mid-single. And that's what they've become more accustomed to. They're not accustomed to global supply levels in data center being double-digit and in certain markets above 20% annual growth. The reality is that that's still insufficient to meet the insatiable demand from tenants like hyperscalers, the likes of your Magnificent Seven, that have immense capital budgets and are funding capital into the space. How do we know this? Well, vacancy levels around the globe have ticked down meaningfully. US national vacancy is between 1% to 2%, which, let's be honest, for all intents and purposes, it's at frictional vacancy levels. I don't think there's an argument that there's much upside for reducing that, right? So really in a strong standing. And the more I talk about it, it's easy to get seduced by the sector because everything's so positive, but it's not without its challenges. And one of the ones that has really come to the forefront is on energy or power availability. And the issue there is not only on the generation side, but more so on the transmission side. And why is it such an issue? Well, these data centers are such immense consumers of electricity that if you don't have access to it, you can't actually develop out a data center because it won't function properly, right? So on the one hand, what that means is that companies that have a strategy to develop out and create their profits and create value through that rather than internal growth, they would be inhibited by doing that if they can't procure the power. But for the incumbents in the sectors, they're probably the most likely in terms of ability and connections to procure that power, right? The flip side is that if supply cannot come on because of lack of power, existing owners of the assets have to compete with less or fewer new supply or fewer new assets that come on from supply, which means that those assets that exist become more valuable. So that's the flip side. But ultimately, we are very constructive on the sector. Clearly, the market is as well. There's no secret of the strength. The one, I think, when there's such exuberance about something, there's always a risk that expectations don't pan out, right? So I think it's important to give a caveat just to temper enthusiasm. And the one thing, it's not our base case, especially in the next few years, we think the demand's too strong. But to the extent that these significant capital investments happen in AI, and when looking back, they haven't generated sufficient enough returns or productivity gains, the logical conclusion is that if it's not achieving those things, right, capital is not endless. For some, it's quite cheap, but it's not endless. And if it's not achieving that ultimate outcome, logically, it would translate into lower incremental leasing and demand for additional space. But that, having said that, that's not our base case for the next few years.
Sounds like there's strong tailwinds. Let's repivot to a different subsector, which is residential. Now, in residential, viewers, we have a lot of subsectors within that. So the first one being apartments, and then manufactured housing and single family rentals. But for first off, let's start with apartments. It sounds like there's also some strength there, despite also some challenges. So can you maybe unpack that for us a little bit?
So apartments, I mean, everyone needs a place to live, right? And for that reason, it typically tends to be quite resilient through cycles. I think just to give context to, just the housing environments in the US, a lot of people have gone through these years, especially these heightened years of inflation, where the incomes are not keeping up with inflation. In many cases, you have negative real income growth. So as that happens, the dreams of, the aspirations rather of owning homes become more of a dream and more disconnected from reality, right? So these are everyday people like you and I that want to achieve these things. So if you are looking to get into the market and it's unaffordable, you look for the next available alternative, right? And that's rental property. And it's more so the case now that you see mortgage rates in the US have moved to that 7% level, which is very prohibitive to buy, and also a psychological barrier where even people that can afford to might think, I'm going to wait until there's a better time to get into the market. So this is really funneling demand from that cohort of people that would be owners into the rental space, and that's propping that up. So that's the big picture view, right? Against that backdrop, we believe that urban core cities with strong job markets, that they continue to do well in terms of apartment demand and limited ability to supply. Yes, you can always go vertically, so that is the risk. But they will continue to generate a reasonable or decent market rent growth, right? Cities like San Francisco and Seattle. In the case of the former, just to give context, it's obviously a very significant city on the West Coast in the US. They've been grappling with social issues of homelessness and crime for a few years now, which has made it a less attractive place to live and work. And what has happened is that residents have voted with their feet and migrated out of the city to other jurisdictions. So the city has identified a need to address the problem, and they've implemented initiatives and cracked down on crime, and making more punitive punishments for engaging in crime. And we're starting to see improvements. They're also creating accommodation to get the homeless off the street and help them through that. And it's making the city more appealing, so people are coming back. So it's really recovering off a base, right? And so we think that continues to improve based on what we're currently seeing. So that's the demand side of the equation, whereas supply is obviously the other side. And like I said, you can go vertically, but more so is the issue in some of the Sunbelt markets in Austin and Phoenix, where supply continues to be an issue.
Thanks, Lance. And then if we touch on the other two, single-family rentals and manufactured housing, what are you seeing there?
If you go back to the post-COVID era, remote working became more of a reality and easier to do. So naturally, people said, okay, let's take account of this. Where am I living in coastal markets, for example? What's my cost of living? What's my standard of living? And by the way, I can improve both of these things if I move to a Sunbelt market, and the delta in affordability is substantial. Unfortunately, as that gap's been exploited and that demographic shift out of the cities, what has happened is that affordabilities converge, and it's less affordable, it's less appealing to move to those markets. So some of those affordability issues are starting to trickle through. Whereas on the other hand, listen, it's still a more attractive alternative to owning, right? But on the other hand, at the lower cost spectrum of residential is manufactured housing. So it's a different asset type. I think it gets a bad rep, but it's effectively recreational vehicle, trailer park communities, and they're actually much nicer than the name alludes to. But these benefit from a concept known as NIMBYism, not in my backyard, right? And effectively, people don't want that close to where they're living or city, so they have to procure land further out and develop and put in significant infrastructure for living there, right? And so it's hard to get these development approvals, so that it's really more so benefited from an environment that's been devoid of supply. And we think that mix of stable, steady demand with a low supply positions it well for the future.
Lance, we have to love all these acronyms that we have in our industry. Hey?
We never have enough.
Lance, all jokes aside and moving on to something that is very unfortunate, but I believe all viewers are aware of it, are the wildfires that we've seen in Los Angeles. So, yeah, I think it's, unfortunate and continues. And I think for us, maybe you can just unpack for us, like maybe from an insurance point of view, what have you heard or read that is quite applicable to the space that we play in, and maybe just from a subsector point of view, the impact of these wildfires. Maybe you can just unpack that for us.
Yeah, definitely. I think it's with matters like this, it's important to acknowledge the devastation to the communities, and our heartfelt thoughts go out to these people. They are grappling with this tough time. Listen, it's a very dynamic situation, but these events are happening more often. And what's happening is, in California, because of these climate-induced events, insurers have actually been exiting California for some while now, which means there's a lower amount of providers, and as a result, insurance premiums have really gone up. So it's something that's really the REITs have been grappling with for the last few years. Fortunately, even though they've left, many of the REITs have national insurance policies and not just localized policies, right? I think some of the national policies still exclude these, but for the most part, they're able to get cover, right? So they should be protected from loss of damage to property and some form of loss of income, right? So I think that they've hedged that risk quite well. I think that's the near-term impact, but long-term, it really does continue to raise the focus on, do people maybe it becomes less of an attractive place to do business, and they go to more climate-friendly areas where the frequency of events isn't happening, right? So that's more of a long-term issue that needs to be addressed. But for the near term, the REITs are pretty well covered. It carries on being a powerhouse of the US economy, so there is a need for Southern California and LA. So we think property will continue to flourish, but these issues need to be addressed, definitely. In terms of the sectors and how they react to these environments, I mean, once again, it's dynamic and no event's the same as any other. But from what we've gleaned from past history and what we can expect, and indications from the market, what the market's expecting is that, property types which require footfall and commuting to an area obviously going to be most affected. So you can see REITs with exposure to LA retail, and which requires consumption, and to offices which you commute to, they've been impacted negatively by that. On the flip side, what we've noticed is that self-storage, which is traditionally a beneficiary of, unfortunately, one of the 5 Ds, I'm not going to get into them, but disaster, they benefit from this almost dislocation where there's a natural disaster. People need to store their goods, people need to rebuild their houses, renovate, and so effectively all these goods and materials need to be stored somewhere, right, whilst people figure out their lives. So that increases demand. But I think, from a social aspect, there's going to be a clamp down to make sure, and the government's been vocal about this, to make sure there's no price gouge or anything about that, but there will be incremental upside for them in the near term. Medium term's a bit more uncertain how that unravels. Apartments, obviously getting some spillover demand from, unfortunately, people having to move out of their houses or losing their houses and needing temporary accommodation. So that's sort of what we've observed now. So it's really in a state of flux, and it continues to unravel.
If I read you correctly, it sounds like fundamentals on the whole are very strong, despite the fact that there are challenges from a macro perspective, political issues at play, which obviously affect the bond yields in the market. Would that be a fair assessment, almost in closing?
So I think, listen, it's easy to be all rosy about things, but I would say, fundamentals are intact, and there's reasonable prospects for the sector. I think investors and market participants are probably, let's be honest, the performance relative to some other asset classes, which have been very hyper-focused within general equities and a few names, the performance has been underwhelming. But it's really symptomatic of the past few years' period where it's been driven by macro political issues. And am I saying they're going away? No, they're probably not. There's probably still another year of it, right? This will remain in flux with a whole bunch of countries going through political elections, Trump's policy agendas, countermeasures from other countries, which is, you can well anticipate that's going to happen. But at some point, if you're a long-term investor and you can focus on the long term, there are really astute management teams in these companies that have done great jobs at making these great companies with, you know, they allocate capital well, balance sheets are well capitalized. There's not too much risk. The controllable risks they've really mitigated. And there's demand for these assets where, you know, they're generating good earnings growth. And I think it's in a reasonably healthy position. Just maybe the sector on the whole, dividend yields exceeding 5% in the sector. And we expect, you know, sort of the near to medium term, that mid-single digit growth in that. So if you throw it all into a blend and you mix it up, what's the output? Is that you're probably getting to that 8 to 10% US dollar return, depending on how the environment ebbs and flows, which is quite a good risk-adjusted return long term.
Lance, as always, thank you for your valuable insights.
Thanks, Vanessa.
Viewers, thank you for tuning in. If you'd like to learn more about the global listed property space, as we've said, there are definitely more opportunities than challenges. Please refer to the full Q4 2024 global dashboard, or alternatively, please reach out to me as per my contact details below. We want to wish you all a prosperous 2025, and until next time, thank you and goodbye.